Thanks everyone for coming. We are excited to have you here. We have our first webinar of a long series that we'll have going through the end of August, and it's all focused on our project in Milwaukee called the Edison. And the Edison is the new tallest mass timber building in the world, once complete in 2026 and early 2027. And today we have Tim Cornwell from the Concord Group joining us, and we're going to be discussing the downtown macro and micro Milwaukee market. And Tim is a principal at the Concord Group who lives in Marin County. If you don't know Marin's a pretty cool county right outside of San Francisco. You can think about nice breeze by the ocean side and great big redwoods. But Tim works in land use economics and development feasibility, and he's been at the Concord Group for 22 years now, even though he looks like he's maybe 30 years old. He's been there since he's 10.
That's the nice Zoom filters, I suppose.
Yeah, exactly. Yeah, it's the filter for sure. But during Tim's tenure, he's completed engagements in 30 US states, 12 countries, and has completed over 19,800 market analysis. Tim is an expert in market-based urban infill development strategies, delivering a best-in-class quantitative and qualitative approach to solving macroeconomic and microeconomic challenges facing urban redevelopment around the United States. And we've been working with Tim for a while now on all of our projects and have really enjoyed the Concord Group and Tim. And so today we're going to kind of just start off by diving into what Tim and his team developed for the Edison specifically, and starting with kind of a macro lens of looking at the primary market area, and then zooming in and looking at the competitive market area of where Edison's located right downtown Milwaukee. And then after that, we'll have about 20 to 30 minutes of Q&A. And we have a few questions that were submitted beforehand, and there was an open Q&A session that you might have saw on the registration form. But we're also happy to take questions live. If anyone wants to ask questions, please put them in the chat, and Tim and I will see those and we can respond. But for the first 20 minutes, we're just going to go through the presentation. But I really appreciate everyone joining. This is our first webinar. Usually we're doing podcasts under Neutral Podcast, but decided to take it live and have an audience here. So glad you're here and happy to have you. So Tim, maybe you can kick us off and share your screen. And
yeah, Nate. So thanks for having us today. It's been a pleasure working together over the last number of years. We have the package that I just shared on the screen, a 66-page package of all the charts and maps and graphs and analytics, et cetera, that we developed as it relates to the Edison in Milwaukee. And usually the way I try to present these is we're going to try to stay out of the weeds. Our data, we like to trade in the proverbial data, the dorkitude of kind of these projects, and really understand, not just where the market has been, but frankly, given everything that we're seeing, all the evolutionary pressures, going on in so many different marketplaces in which we work, like really what comes next, right? And so I'm going to try to give, the audience here a quick synopsis of some of our key findings and conclusions, put some of that data into context, and then, we'll be, 100% all ears as it relates to the questions to come. And yeah, I mean, for us, 900 of these every single calendar year, which is the math that you did around 19,800 projects. But this means that the throughput becomes extremely valuable as we look at, frankly, the near-term future of so many of our cities, and understanding, how the demand and supply balance works out, right? What we're seeing from a demographic substitution effect, so many of these key trends underpinning, new development. So this package, which I think you're going to make public in the larger, marketplace, but as we think about it, right, sort of organized into a couple different sections: the macroeconomic overview, where we're going to really look at some of those demographic and socioeconomic drivers, what we would say is the rental opportunity analysis, and then tying it to some site-specific analysis and conclusions to be, really a parse through as we think about, key development opportunities and how we nail down a unit mix and sort of rents, right? So first things first, it always starts with setting key market areas. And for this document, we're going to use three. Okay. So first, obviously, we have to look at the Milwaukee MSA, right? We're not going to do too much with that writ large, but that, the black outlines really represent the MSA as a whole. Then as we start to think about what is going to be important in the analysis, two geographies, right? Primary market area, Milwaukee County. And then we have this red outline competitive market area, which we think is much more germane to the conversation as it relates to how supply and demand is going to play out, right? Who and what we're targeting with this asset, right? How the individual micro markets and sort of draw areas are really going to play, right? And so you can see, talking top to bottom, kind of how we've laid those out, defined by zip codes or census tracts, by the way, so that we can have some intellectual honesty with the data. But really, when we use the term CMA or competitive market area, we'll use that larger downtown Milwaukee geography to play that role. Okay. And so as we talk about the demographics, I mean, this is absolutely a sea of numbers. So I promise I'm not going to talk about every single one here. But within that competitive market area, that core of Milwaukee, today we've got about 43,000 people living in what is effectively 26,000 overall households. Okay. And when you look at the growth that's projected every single calendar year, that's 546 net new households through 2028. Okay. And what that means is we're representing about 2% year over year growth. Now, just for context, the primary market area, the whole county, doing about 0.2%. And by the way, the USA doing about half of 1%. So when we look at that in town core of Milwaukee, the rate of overall household growth and in-migration, backstopped by so many different factors, both microeconomically and macroeconomically, right, is basically 2 to 3 to 4x what we're seeing, kind of in some of those other overall geographies. The other thing that's so important in this construct is like, look, this place historically, when you look at who lives there now, has a $63,000 median income and a $101,000 average income. So if you remember elementary school stats, right, the mean and the median, right, it's really, look, a bulk of people that are kind of in those middle incomes, but then increasing pressure and more of those outliers towards the $100,000 plus, okay? But when we look at that overall market and the $63,000 median income, right? When I take that 550 net new households every year that we're projecting, that we're seeing kind of happen every single year through 2028, and you break it down by income, something really striking falls out of this, right? Of the 546, 500 are over $100,000 of household income, and very, very few are under that $100,000 threshold, right? And by the way, this is something that we're seeing in so many of those different cities in which we work all over the country, right? There's sea change playing out, and this happens because of many different reasons, right? More and more double income households, both from preference and necessity, right? More wage pressure of those kind of key, individuals, right? There's some displacement that happens, gentrification, there's combination of households, right? There's movement towards those more affluent individuals and more affluent households when you look at where that future is, especially in the context of the recent past, okay? So as we move this forward a little bit, right, we sort of talk about some of the other dynamics here, right? When we think about kind of the buy versus rent decision, and we'll talk more about this to come, but basically when you look at that CMA, we're in a situation where of the, 26,000 total households, almost 80% of them are renters, right? So when you look at that in-town area, very few ownership options, right? We're seeing price, discrepancies clearly. And when we look at that, that means that we're talking about an environment that has north of 20,000 renter households within that competitive market area as a whole, okay? And when you look at kind of what happens next, right, when we go again to that competitive market area and you just use the median and average, right, the simple elementary school stats, right, $63,000 median income at the end of 2023. When we get to 2028, that's going to be $73,000, right? And that's all about loss and displacement from the lower income individual and aggressive growth that happens in those kind of key 150 to 200 and even over $200,000 household incomes, that are playing out within that competitive market area. So it's kind of interesting, right? Because if all else is equal, right, and you look at the shape of that income curve and that shape of that spending power, we're seeing that increase on a median basis about 3% per year compounded for the next 5 years, right? If you look historically, right, again, there is a very big difference between who the renter was and who the new renter that's showing up, specifically around the very best of the best product in good locations with good execution, is really going to be, right? But when you look historically, it's actually true to say that something like 60% of all of the renters within that competitive market area are actually under $75,000 of household income. Okay. And we are also breaking down their ages and their household sizes and all the things that are kind of key to understanding who and what your holistic demographic really is. Okay. But I think that the important thing to put out there into this conversation, right, is that again, that historical renter has given way to a very different household, a very different near-term future. And if you look at the 5-year data from the US Census, albeit a little bit of a lag because it's the US Census Bureau, but 2017 to 2022, there's been a 13% increase in the total number of renters. But when we start to break that down, there's fewer renters, right? Under $50,000 of household income. And then when we start to look at these upper and income categories, right, what I, again, very lovingly call the drop the mic and walk away point is that in a 5-year period alone, we've seen a 136% increase, also known as more than a doubling in 5 years alone of the number of renter households in that competitive market area, up over $150,000 of household income. That is 1,350 new households that didn't exist there in the pre-COVID period, right, with the kind of top tier spending power. Okay. The other thing that's really interesting, and by the way, this is something that, in those 900 assignments, we deal with all the time, specifically around developers, right? And the conversation around, who really qualifies to be your renter, right? Because so often what happens is, affordability is put in the context of current rents relative to median incomes. But in environments that are going through this level of change and have a substitution effect from a demographic and income perspective, what's happening is actually you're stepping further and further and further and further away from the median income as evolve as a marketplace, right? So it's actually incredibly um, inopportune actually to really look at rents relative to median incomes to describe affordability. Okay. So this last section at the bottom, what I think is important to enumerate, right, is if we pay attention to not the whole of the income curve, but what we truly believe to be the addressable market, right? Those that are over $75,000 of household income. And I look at what they're actually spending of their income on housing right now, right? It turns out that population, 2/3 of them are actually spending less than 20% of their income on housing, which means they're not rent burdened, right? We can probably turn their dial a little bit, especially when you look at the better product, right? The best units and the best product, right? You can sort of see the return from a pricing on a per square foot value basis, and also as it relates to, kind of where those incomes are for those key residents, right? We obviously look at job data, right? I mean, the whole story here, it's so fascinating, right? Because if you look at standing, in early 2023 and looking at the projections for the rest of 2023, there were some real constraints, right? I mean, there were some, real challenges that relate to net job growth. But, we ended the year in 2023 with positive growth. We had 5,000 net new jobs in the MSA as a whole. Obviously, slower growth than we have had historically, right? But we still like what that's doing from a job pressure perspective. And then you start to look at things like, where are those employment categories, right? Who and what is really showing up? And what you see is the professional business services, the eds and meds, information technology, financial activities, like these guys that have the higher salary rates, right, are the ones that are combining and contributing to the highest rates of growth, right? And that's part of the reason that we're seeing more of those $100,000 incomes, really show up. Okay. We also look, by the way, at the commute patterns and the commute shed. So again, this is a little laggy. You got to grain of salt this a little bit because unfortunately, again, Census Bureau doesn't report this really quickly. But one of the things about the competitive market area is we're in a situation where we have effectively 84,000 jobs that exist there on a daily basis. But we only have 20,000 people that live there that hold a job, which means every single day, right? When you look at the core Milwaukee competitive market area, you see a net inflow of some 63,000 employees, right? And that's a huge component of urban demand, right? What we've seen in so many different analog markets all across the United States is that 4x daytime population versus nighttime population. That means that as we go through the delivery of better quality product with those income and affordability tailwinds, we get to sort of pick off some of that demand that historically has been forced to, commute in from outside the area, right? And by the way, we also look at the net in migration, right? So, one of the questions we'll be talking about is like, Milwaukee's competitiveness within the larger regional whole, right? And we can really see, the in migration, predominantly Illinois, right? But you also have California, Colorado, Texas, Florida, some of the Northeast, right? Providing that in migration at a higher level. And by the way, we also like to look at the U-Haul data in very real time, right? So U-Haul, they allow us to kind of look at the rates of renting these trucks on one-way moves betwixt and between these different cities. And I mean, if you think about it, right, if I go rent a 26-foot U-Haul truck in Chicago, drive to Milwaukee and drop it off, it's $263, right? The same exact truck, the same exact day, but going from Milwaukee to Chicago is $173, right? So these pricing disconnects allow us to understand, okay, well, where are we probably going to gain people from, right? Where are we going to lose people to as it relates to that real-time migration? Okay. Now this slide, I think there's a couple things to say here. Okay, now this is residential building permits at the MSA level, at the primary market area level, going all the way back to the 90s, right? And there's a couple things to say, right? First is when we look at the residential building permit issuances writ large in this entire geography, right? It's pretty clear that when you look at the recent years, right, we're way, way off what we saw in even the mid to late 90s and early 2000s from total housing production perspective. And that's, by the way, not super surprising. I mean, that's probably more of the rule than it is the exception in all of the the work that we're doing all around the United States. Okay. However, when you look at what's happening, in the context of the larger US, right, those, declines that we've seen recently, they follow a big giant peak of residential permits that was occurring in 2020 and 2021, right? And so what's interesting is that Milwaukee really hasn't taken the same or hasn't played the same role, right, as many other markets in terms of recent real upticks of new supply, right? So there are, and we're going to parse through that data when we start to look at very specific submarkets and very specific product types. But from a holistic housing need, we aren't doing what we really need to as it relates to the rate of growth that we were talking about, in some of those key market areas earlier, right? And the decision point between buying and renting is starting to evolve, or maybe we can say actually devolve, right? As it relates to some of those implications of being long-term housing undersupplied or constrained, right? And so the only thing we needed to look at here, right, is the graph along the bottom, right? Everything else is really how we do it. But basically, the black line is when I look at that specific competitive market area, we look at median home prices and just run it through a very simple amortization, right? So average interest rate that year for a 30-year fixed, you assume you got a down payment, you got a little bit of load of insurance, maintenance, and property taxes and things like that. Like, what does it cost to be an owner, right? Relative to where the rents are within that same geography. And when you look at the home price appreciation that continues unabated, right, despite the huge disruption of interest rates that we've seen, okay, right, running these kind of, low 3% ranges down to the, up to the, upper sixes, which, by the way, if you were going to go do that right now, might very well be a 7.5% 30-year fixed, right? Not, for a conforming loan. When you look at the gap between owning versus renting, we're in a situation where we're at 80+% premium to go be a buyer versus a renter, right? So, what this does is more affluent people are going to be forced to be renters, right? The renter nation, the kind of movement of those $150,000 plus income earning renters, where we've seen a 150% increase in a 5-year period alone. That is our foreseeable future when we look at this competitive market area, right? And in fact, we do things like, okay, well, when you look at, actual specific units, right? So as a case study, 311 East Erie, number 216, right? This is a 2-bedroom condo that sold for 610 in April 2021, right? If you believe what Redfin says, or someone like that says it's worth now, 730, right? Which is 20% in 3 years. Well, when you add the interest rate expansion to that, right? We've seen, the cost for that, product itself increase by nearly 40% in terms of what it cost that owner to go serve the monthly mortgage, right? More affluent people kept renting in. You can see, in the comp data, ultimately to come. Okay. So we look at the historic macro performance, although I think what's much more important is as we really delve into the actual performance metrics of the key comps themselves, right? And what I'll tell you is these two exhibits are basically, you know, uh, it's an effort. There's no doubt about it. We're shopping comps as many as 5 different ways these days, given what's going on in the marketplace. We're going through a research process to really triangulate the actual performance of each of these individual deals. And we'll talk more about them individually to come. But when we look at this sample set, it's about 5,400 units. You have an average year built of 2018, right? The occupancies, when you look at the stabilized deals, are in the mid 90s. But when you look at them physically, 78%, because you have several of those projects that are still in their first time lease up, right? And when you look at this holistically, again, with now 6-7 year old product, we're talking about 860-foot units, $2,200 rents, and in the mid to high $2 range. But what's important is when you start to look at the high end, right? And we've bolded some of those projects. So Couture, 333 Water, right? In the historic ward, excuse me. When you look at some of the other key comps here, right? The top tier rents that you're seeing in these products, right, get into the mid to high $3,000 a month and the upper $3 a foot range, right? Approaching $4. Okay. And I think this is a really important, a conversation to be had, because there's an elegance to where the comps and the supply side and then the demand side are really triangulating, right? Because if you go through the math of about $3,700 a month, right? Let's kind of pick a weighted average through that. And you sort of say, okay, look, that's going to be the high end, right? If that $3,700 a month is spent by a person's, basically spending a quarter of their gross income, it means that overall throughout the building, we're basically getting to about $180,000 of household income in that individual building, right? Which again, that's the population that has really changed. That we've seen 150% increase in that group of people in this specific competitive market area over the last 5 years, right? As we think about kind of some other metrics here, right, we're looking at the pace of absorption writ large, right? I don't know that the overall per month leasing velocity is a huge positive at the moment, right? I mean, I think that's something that we're going to have to pay attention to, is how quickly do we move units on a 1-by-1, month-by-month basis. But what I would say is really important to understand is, look, we've got 5 deals doing 10 units a month, 12 months a year. That's a run rate at these very high price points of some 575 net new units of absorption every year. When you add back those that are recently stabilized, 7 times 10 times 12, that's 870 units per year in terms of the size of this market and how much absorption is actually physically playing out, right?
Tim, one thing I want to note on that slide is 333 in March was just opening. So when we got this data, it was like 2 days after they had their grand opening. So that's why you see 1.8%. We haven't gone back yet and gotten their new data, but it's as of March 1st, and they opened, I think, on February 28th or 27th. So that's why if you see that 1.8 number, it might look skewed because of that fact.
Yeah, so I don't think we have enough points of sale to really kind of judge that from a monthly basis, right? But I do think it's a situation where, we are seeing real absorption at the high end, right? And pushing price points in quality product. Okay. Now, to that end, this next graph is the one that, I personally could spend an hour talking about. I promise I will not, right? But most developers in the world understand that as you go from small units to large units, right? In a typical rental market, what you see is a huge drop off in rents on a per square foot value basis. Okay. And that has been how the majority of multifamily markets have worked over the longer term. Okay. That's changing. It's changing everywhere and it's changing fast. And it has a lot to do with kind of the combination of, who the new renter is, the demographic destiny of the United States, right? By the way, the peak millennial that we've all been chasing around for more than a decade as it relates to urban multifamily product, the peak millennial nowadays in the United States is 36 years old, right? So some of the motivations as where they locate themselves, what kind of amenities and product they're looking for, how many bedrooms, what's the square footage, what's the affordability, all of those issues are evolving very quickly, right? And so as we think about these two graphs of the holistic market, right? By the way, each one of those dots is a floor plan that's out there in the marketplace today, color coded and unit sized, et cetera, by studios, 1 bedroom, 2 bedroom, 3 bedroom, right? The reds are studios, the orange are ones, the greens are twos, the blues are 3 bedrooms, right? You see a very interesting and more common phenomenon now showing up, right? Is that there's sort of two markets that have shown up. There's everything sort of what we might call under 950, 1,000 square feet, which is very clearly, right, the shelter renter, right? People that are looking to put a roof over their head in a very quality building in a good in-town location, but have to be price conscious, right? I mean, they're in a situation where they are spending a good chunk of their income on housing. And when you look at that product, right, there's clearly a very tight band between the very best deal and some of the more commodity luxury product that's now aging a little bit, right? And then the best of the best, right? And when you look at sort of the per square foot value degradation in studios and ones, we're in a situation where we do see some significant negative, or significant drop off in rents per square foot from the smallest units to the largest units. Okay. But then something really interesting happens as we get north of 1,000 square feet. All of a sudden, the affordability, the inelastic demand to additional price, the kind of stronger incomes show up. What I sometimes call, people at the very top end of the scale with all the spending power, right, become more and more part of your marketplace. And all of a sudden, the very best deals, right, and then the commodity luxury product starts to see significant deltas, right? We start to see $2,000 and even $3,000 premiums in the very best units versus the commodity luxury product that makes up the kind of general historic competitive set. And so, in fact, what ends up happening is you see a U-ing of the per square foot value curve as you go from those shelter renter units to the lifestyle driven units at the top end of the scale, right? So this is an incredibly interesting phenomenon as we start to think about, like, how do we deliver a unit mix that optimizes the development deal in the context of all these changing renters that play out, right? And a situation where when you look at the demographic destiny of the United States, we're going to be talking more and more and more and more about -2 to 2-year-old kids. I don't even necessarily have the baby in my hands right now, but I'm starting to think about how this works, right? But I'm also not willing to commit the social suicide of the suburbs yet and really, exit for the hinterland locations, surrounding our core locations. Okay. Moving us forward, just really quickly, we have to get into the pipeline math, okay? And so we go do a full census of all of the plan and proposed pipeline that exists within this marketplace, right? And we have about 4,500 units of total market rate potential inventory. But the thing is, nowadays, right, with the rate movement that we've seen, with capital partner expectations, with entitlement issues, the BMR challenges, all the fundamental underwriting challenges, right? We know that there's no way that we're going to deliver all of that potential product, right? And in fact, only 786 of the 4,500 units that are out there in the pipeline are physically under construction. So we go through a process where we go one by one by one by one through every single one of those deals and basically say, okay, well, what do we actually think gets delivered and when, right? And it turns that 4,500 unit potential pipeline into 1,900 units that we think will deliver by the end of 2028. All those deals are the projects that we're tracking on a map, all color coded by, by their status and likelihood of execution. And then we marry it to the demand side, right? And so this first page is really all of the inputs into the demand model. This is at the primary market area, so the county level, right? We look historically at the rentership rates and ownership rates by different incomes, right? We also have to think about where those go going forward is a very, very different future than we have had in the past. And this is a great example of it, right? Because if I go look specifically at the 100 to $150,000 income category, okay? If I go, historically, only 28% of the people that live there in that market today that are between 100 and 150K of household income are renters. But if I look at the growth over the last 5 years in net new households, it's been basically a 50-50 mix between renters and owners, right? So we have to use all of this math to understand what we think the next 5 years of rent versus own decisions are going to be, how the kind of affordability and income to housing rates are going to work, and then some of the key inputs as well being turnover of existing units and obsolescence of the existing units. This, by the way, describes some of the flight to quality that you're going to hear about, when you think about this industry writ large. And so as we go through that and we think about it left to right here, income ranges, we're using 75K as a floor, right? We're using the truth as it relates to what percentage of people's income do they spend on housing, right? It's arithmetic to get to monthly rents. You have households at the end of 2023 and end of 2028, right? To kind of give us that 5-year growth projection. You get a little bit of the bump from the turnover and obsolescence, but the entire ball game here is all about how many net new households exist or will exist, I should say, for each of those individual income categories. And then the big call we have to make as for these next 5 years, who is a renter versus a buyer, right? And that gives us about 2,000 units of income qualified demand at the primary market area level that we also have to do a whole bunch of math to understand where does that go between different geographies, right? And so as we look at it, again, intellectually really interesting for me and having seen this over 20 plus years, right? Because if you look at this competitive market area relative to the whole county, we're only about 6.6% of all the households that live there. Now, it's higher when you look at the 1 and 2 person households and you look at the renter households and all of those kind of factors, right? But when you look at the growth projections, it's 70% of the net growth, right? So these markets are not created equal in terms of their fair share capture for this period of American history, right? You have a collapsing and combination of households into kind of urban areas. You have new suburban, geographies. You have the nature of work disruption. There's so many things that are going on. But when we go through the whole math, right, what we're saying is we believe that this competitive market area specifically, all of these different metrics being part of the equation, right, and all treated, and weighted, we think that we should be about a third of the overall demand of the county, right, from an income qualified rental perspective, which is some 710 units per year. Okay. And then when you go and you look at the dynamics that we're seeing in practice, right, remember, right, we've got 710 units per year of demand is our projection, right? But by the way, remember that run rate of annual demand run rate of annual absorption that we're seeing across those new deals, with the caveat that, a couple of them are recent. We don't have full returns yet from only, a month of actual absorption, right? They're hitting 570 units on a year by year by year basis, right? So we can have a lot of confidence that the scale of the demand, the size of the market is in that, call it 700 units per year of income qualified rental demand, right? And so this exhibit, and this is the last one that I'm going to go through, and then I'm going to turn it back over to you, Nate, right? As we think about the supply and demand math, here's where we're putting everything together, right? 786 units of under construction inventory that we know will deliver, another 1,100 that probably will deliver. By the way, those are the pink hashed ones, right? By the way, there's also 870 units of product that hasn't yet been absorbed in actively leasing projects. So that's got to be added back to the math. And all told, you get to about 2,700 units of what we might call overall supply, right? When you put that in the context of the pro rata rest of the year 2024, and then the 710 beyond that through the same calendar year 2028, that's about 3,400 units of income qualified rental demand, right? Which means we're left with an undersupply of about 700 units net, right, by the end of 2028. And just so you know, this curve that you see right here is so common, right? I mean, we have, I would argue, been generous about projecting deliveries that have not yet started, right? But it's becoming increasingly hard to get these done, right? And the nature of how long it takes to entitle a project, how long it takes to build a project, right? It's like turning the battleship. So we're paying attention to this in a very dynamic way, right? Like, I would argue that this 360 units of delivery and this 484 in 26 and 27 is at reasonable risk of actually getting done, right? And so when we look at the supply and demand dynamics, it's very common to see these years of a little bit higher supply as we transition out of the existing delivery system to projects that would have had to start in the last 18 months, right, in a very different capital environment, is getting harder and harder and harder to get done, right? So we see some significant constraints on the supply. And there are plenty of markets, by the way, where when you look at it, intellectual honesty, there aren't really any deals that get delivered in 2026, right? And so this is a very common refrain that we're seeing, right? Is the supply cliff is pretty common and relatively obvious. Okay. So with that, I want to stop the kind of talking at you with all the charts and maps and graphs, but Nate, I'm more than happy to
Yeah.
answer all questions, both what you have prepared and then also anything from the group if they're more than willing to put into the chat.
Yeah, no, I appreciate you taking us through that. I mean, I was writing down and I had some notes before this of just kind of cliff notes for maybe those who don't like all the numbers, which I know it can get daunting at sometimes, but it is good data to review. One big thing I think that's a crucial item for Milwaukee, because we office in Madison, and I know for local Minnesotans and even some Milwaukee people, they're like, well, Milwaukee's had a uh, net zero basically migration for the last 5 to 6 years, which is true, but it's at 0.2 for the overall PMA, like we said when we started. But downtown in the CMA is at 2%. And so I think that's a really crucial stat as we look at, okay, does it make sense to build this big high-rise tower right in downtown Milwaukee? And the answer is yes, because downtown Milwaukee is really thriving, whereas the overall PMA might not be having this huge immigration.
Well, and I think let's be very real about this too. I mean, the demographic and socioeconomic substitution that's playing out is incredibly meaningful, right? I mean, there are plenty of markets that have limited net growth, right? But the growth for the addressable market of what we're talking about building continues, right? And that's because the growth of the higher income households is matched and in some cases even exceeded, right, by loss or combination of households, from the less affluent, right?
Yeah, that was another cliff note I wrote. So for the total addressable market that we're looking at, we're looking at between above that 75,000 mark, but for some of our maybe nicer units or penthouse units, we're in the 150,000 and above. And there's been 136% increase in those renters over the last 5 years, which we really do think that's going to continue, especially with all these bigger employers starting to either relocate from the suburbs back downtown or expand their campuses. So we have Northwestern Mutual that's adding 2,000 employees. We have Pfizer that's relocating from Brookfield back downtown with 1,000 employees. We have Milwaukee Tool that just expanded with 200 employees. We have Right Height who just expanded with 300 employees. And there's a ton of others that we can send out after the call that are all really consolidating their headquarters back to this downtown CMA that we're all talking about. And so we really think that's going to add to this growth. And the other cliff note that I want to end on, and then we'll open it up for Q&A, is 70.2% of new households are being created within the CMA of the total PMA, which I think is a really key stat, 70.2. So that tells you that people want to live downtown, right? They want to live in this urban core. They want to feel the urbanism of Milwaukee, of really the gentrification that's been going on in downtown Milwaukee and continues. And I don't think that's going to stop, especially with everything that the city's doing and all the development that's going on. So unless Tim, you have any other points, we'll maybe open it up for Q&A, which we have a few questions that we already received.
I'd love to, yeah.
Okay. So question one, I'm going to put it in the chat just so everyone can see it. But it says migration flows point to a trending decline in Milwaukee's population over the past 10 years. In an effort to reverse course, what are some initial steps both the city and investors should prioritize to spur young talent moving to the area? More specifically, what do you envision as Milwaukee's identity to attract this talent?
Yeah, I mean, look, I think it's an interesting conversation writ large, right? Because, pre-COVID, even we were in a place when we were looking at affordability of different metro areas, right? And how wars for talent had concentrated into one of what, 10 gateway cities that we all could name top to bottom, right? It was a very have and have not marketplace as it relates to primary cities, secondary cities, and tertiary cities, right? And COVID has really disrupted that. And we kind of talked about it historically as we believed that there was going to be this next great American move, right? Where the lifestyle, the amenities of the city, the job market that you just described, right? As it relates to kind of those key pools of talent, begin to elevate the place and make you more competitive against so many other nodes, right? And I think that that's really the answer here, right? Is it's really investing in the place, right? Making a live work play 24-hour. There's almost so many buzzwords around that, right? But from my perspective, it's about delivering on the public space and the infrastructure investments needed to kind of really make it frictionless for people that want to move here, right? Developing the quality product from a residential perspective that competes with what those individuals who maybe have lived in New York and Chicago and San Francisco and LA and wherever, right, are going to be or are sort of ultimately looking for, right? And then also, kind of capitalizing on some of the tailwinds you have that, look, I mean, let's be very clear about this. When we talk about delivering on that urban promise, some of those job rich environment locations, the growth conversation, the focus of the core, right? In many American cities, that's $5, $6, or $7 per square foot, right? And here we're talking about the top tier is 4, right? So understanding those implications, what it means in terms of like the identity, right? And making sure that we think about building buildings and spaces and local amenities, right? That don't just play to the historic young professional, understanding that we're in a situation where, people that used to be 27, 28-year-old millennial peak are now in their mid 30s, right? And some of the value system is evolving, right? And so that's in building the public spaces and building the private spaces and designing unit mixes and thinking about, who our renter profile is, to continue to be able to attract that talent, right?
Yeah, I mean, I think the other thing that we need to consider here is Milwaukee as a city is doing a lot of urban redevelopment and gentrification, both with bike paths and all the street improvements that they're doing and the park improvements and the potential I-794 takedown. And so there's a lot of things that the city has been doing specifically for that area that we've all been talking about, the CMA, that I think are going to really add to this potential like tech client or young professional that wants to live downtown to really actually pull the trigger and do it. The other thing that we've been seeing is there is a uptick in the commuter traffic between Milwaukee and Chicago on the train. And just last year, there was a 16% increase in net commuters from Milwaukee down to Chicago and then Chicago back to Milwaukee. And I think that what that told us is that there's a lot of people working in Chicago that don't want to pay the $5, $6, or $7 rents, that would prefer to pay $3.50 or even $4 for top of market nice assets and commute on the train for an hour down to Chicago and back instead of living in downtown Chicago. So I think there's a lot of different kind of value propositions that Milwaukee has. Tim, I know the next question that you might not be super familiar with since you're in sunny Marin, but I know you have a little background on this. But question 2 is proposed removal of I-794. What are your thoughts for or against the removal? And for the audience that maybe also is not in Milwaukee, 794 is like the main interstate that goes basically right down the middle of downtown. On one side, you have historic Third Ward, and on the other side, you kind of have core business district. And there's a proposal that's now actually got a lot of traction, which is great, for that to be basically fully removed and it to turn into a 4-lane kind of more pedestrian focused street. So maybe Tim, you could talk more broadly about what you've seen across the
Yeah,
US.
yeah.
It's
Look,
interstate removal.
I cannot make the against case whatsoever because that is a level of, traffic flow and people movement that, obviously the traffic engineers really have to think through. But the for case is so clear, right? I mean, there is example after example after example of, historic monolithic freeway infrastructure cut directly through, kind of core downtown cities, in many cases, leaving a marketplace in two, right? With elevated freeways that once removed, give way to incredible urban revitalization, right? Delivering a human scale, more pedestrian friendly, like more stoop to street frontage. I mean, there's so many examples of this. And I mean, since I'm here sitting in downtown San Francisco at the moment, which has its, pluses and minuses, there's no doubt, right? I remember, the Embarcadero Freeway is the clear, obvious analog, right? And the Embarcadero Freeway, once damaged by the Loma Prieta earthquake, was then brought down, opening up our waterfront effectively, right? And removing this big barrier from the existing development activity within San Francisco and sort of some key physical assets, right? And I mean, there's so many, positives that came from that, right? And it's not the only example, right? There's freeways that cut through American cities all over the place that have been more thoughtfully planned, right? That kind of have created some very positive development opportunities and revitalization opportunities that really benefits obviously the micro location, those directly on the frontage, but also a little bit more of the holistic everybody, right? Is that you have urban fabric that's more closely knit together. You have property value increases. You have activity in terms of people on the street, right? Shopping, window door experiences that exist that become extremely positive, right? So I mean, obviously there is an against case, but I don't know that I'm educated enough to really put it out there. The for case is quite clear, right? And that has happened all over the United States.
Yeah. Yeah. I think everyone should be for this one. This one's, I think, a pretty clear decision, but we'll see how it progresses. Question 3 is, what are the factors contributing to growth in the Midwest? And will the Midwest start to capture larger shares of people leaving gateway or Sunbelt cities that have seen huge price
Yeah,
increases?
I mean, I think the question answers itself, right? I mean, it's really the huge price increases at the bottom, the relative value proposition to me that is it is really maybe the biggest truth here, right? I mean, I would maybe say that there's kind of two different subtle theses in this question, right? The first is, of course, look, the relative cost for the lifestyle, right? And these regional connectivity issues, right? Chicago, Milwaukee, I mean, like those those super regional locations and how they can be more competitive writ large, right, with other areas, both in terms of lifestyle, in terms of job market, in terms of future prospects, in terms of affordability, all the things that really just drive the decision making on where people site themselves, right? And when you look at it, it's not just the Sunbelt cities, but certainly the gateway cities, right? The cost of doing business, the challenges from a over densification, kind of an under delivery of new supply, and the resulting price increases have left a lot of our American population at a very important part of their lives looking for, well, okay, where do I put down roots, right? And so I think that's an important answer to that question. There is another subtle piece that I think doesn't get talked about very much that I do think is, I guess, to me, at least a little bit interesting, right? And that is, as we've been working with a wide variety of, capital partners and developers and people allocating time and effort and development dollars, right, in a more scarce environment, we've been helping to guide them as to where do we think we're going to see outsized, rent growth potential, right? Or where do we want to put our investment dollars? And one of the interesting things that often gets asked of us to include in those type of approaches is, climate risk assessment. And so when we start to look at a lot of the kind of Sun Belt part of the United States, whether that's heat, utility issues, hurricanes, and extreme storms. I mean, you can go through the mix, right? When you think about a warming climate, right? There's some potential that, we need to evaluate some of the markets that used to give up, right, fair share to the Sun Belt a lot of times because of snowbirds, right, to see more resilience over the longer term, right? So it's not something that we're kind of hyper focused on now, but that is an interesting avenue if we think about the long game.
And just to stay on that point for a second, Tim, do you think that you're starting to see some of those investors and capital allocators start to really consider that as a part of their investment thesis and
No
say,
doubt. No doubt.
really, okay,
And I mean, fundamentally, the other point is when you look at those markets writ large, they've had nowhere near the supply, right? I mean, if you look at the darling cities of the Sun Belt, right? In every case, they're struggling under the weight of massive deliveries, right? I mean, if you go and total up, Nashville is the best example of this, right? If you go and total up the overall scale of pipeline that's being delivered to the multifamily industry there, right? I mean, the 5-year pipeline is more than 100% of the existing renters, right? So again, I mean, there they have a relentless strong demand. I mean, in some cases, you're dealing with 4 and 5% year over year household growth, right? And the same sort of income dynamics. There's no doubt about that. But the secret is long out, and there's rows and rows and rows and rows and rows of pipeline, projects as part of that about that near term future, right?
yeah, I mean, I definitely think it's a great little secret we have here in Wisconsin and definitely in the Midwest that, you look at Nashville, like you just said, but I looked at Phoenix the other day. I looked at Austin. You look at some of these Sunbelt markets that have been like hot with institutional investors, and they're cannibalizing themselves. Like they're just building so much that it's going to take them years to absorb.
Yeah, I mean, and 3 month free concessions are common. I mean, look, now there's clearly, I mean, you got to be careful about the short term, middle term, long term case. Like the long term case is clear. The middle term, you will absolutely get through those, it's the proverbial pig in the python. There's some indigestion because you're trying to digest this giant pig, right? But I mean, the growth factors, the role that those cities play, some of those big shifts we like over the longer term. It's just the next 18 to 24 to, in some cases, 36 months that probably look a little bit painful,
Interesting. Okay, question 4. Mayor Johnson, who just got reelected, talks about increasing density in Milwaukee and shares a vision to bring Milwaukee's population to 1 million residents. Do you believe this is achievable? If so, when and how will Milwaukee get there?
Yeah, I mean, it's just math, right? I mean, for me, the huge constraint here is like you have to have a demand side factor and then a supply side factor, right? As it relates to actually being able to cite those people. And so, look, I mean, the demand side is all about jobs and economic development and really kind of going after that kind of demand side pressure and competing in a much more regional, super regional, and even national economy, right? And I think those are all sort of at some level self-fulfilling, right? So the work that gets done in that arena has to be balanced and probably um, even accelerated in some ways by making sure that we have the housing deliveries across a wide variety of pricing spectra and also ownership and rental, dynamics to really pull it off, right? And so those are the foci to me, right? And I mean, look, I don't know that there's a specific date for this, right? I mean, if you look at it, it might take a little while to get to a full 1 million residents because of the in and out migration and the net that we were talking about earlier, right? But I think that that's absolutely deliverable if you can, deliver both on the demand and supply side.
Yeah, that makes sense. Yeah, I mean, it's definitely one of those things that it's achievable. It's like, how are we actually going to get there, and who are all these people that are going to be immigrating to Milwaukee? So I think
And I mean,
it's
it's interesting too, because like the population and the households, like, you know, I actually don't really trade in population that much. The whole thing for us is all about how those people organize themselves into households. And I think that is an interesting near term future for the United States, right? Again, peak millennials at 36, starting to think about, hey, where am I putting down roots? What is it? How does that work for the longer term, right? And sort of who's in my household becomes a very dynamic and interesting near term future.
Yeah. Okay, I have one more question and I think we're gonna have to wrap it up here. But my last question is you mentioned that there's 2/3 of the families that are in our kind of core CMA spending less than 20% on rent. And in your mind, when you look at markets, what is a good kind of rule of thumb for a person to spend on rent?
Yeah, I mean, it's interesting, right? Because HUD will tell you to spend a third of your gross income, but very, very few people do. And actually, in fact, what happens is that the less affluent people spend as much as 40 and 50, and even in some cases, 60% of their gross income on housing, right? Whereas the more affluent individuals, it starts to drop down into the teens very commonly, right? But for us, the rule of thumb, I did that earlier, right? In terms of the rents that are being paid in the very best of the best comps. I use the times 48, which is basically someone spending a quarter of their gross income on housing, right?
Okay.
So that's kind of where we want it to be, right? Somewhere in the, call it, mid 20s in terms of where your target resident is gonna ultimately be.
Awesome. Well, I really appreciate you coming on, Tim, and thanks everyone for joining. We will be posting this to the Neutral podcast where we have all of our other episodes, and we're going to start doing this every other week with a few other professionals. Our next one is going to be with BDO, talking about taxes, accountants, just love it. And we're going to be talking about 1031 exchanges and cost segregations, deductions, and then tax credits under the Inflation Reduction Act. So should be a good session as well. But really appreciate this one with you, Tim.
I guess